Despite the fact that the economy was doing well a few months ago, some analysts believe that today's growing inflation might be the beginning of tomorrow's recession. However, what exactly is a recession, and how can you get fully prepared? Hi, Jared here, and today let's talk about recessions. The National Bureau of Economic Research, a private non-profit organization, is regarded by economists as the official referee of recessions. It defines a recession as a significant decline in economic activity that is spread across the economy and that lasts for more than a few months. Typically, that means at least 2 consecutive 3-month periods when GDP has declined, taking inflation into account. In practical terms, a recession is an increase in unemployment when demand for goods and services, prompting companies to lay off people, further suppressing demand for products and services. Companies are downsizing rather than growing, making it difficult for the unemployed to obtain jobs, worsening the slowdown. So, what causes a recession? Economists point to several variables that might cause the economy to slow. So far in the 21st century, the US has had 3 recessions, each with a unique cause. The stock market suffered several losses from March to November 2021. First, when the dot-com bubble broke in late 2000, then when terrorists crashed aircraft into the World Trade Center. The Great Recession, which lasted from December 2007 to June 2009, was brought on by a financial industry catastrophe linked to the subprime mortgage crisis. And finally, the temporary but severe slump from February to April 2020 was caused by COVID-19, obviously, and government-ordered travel and commerce restrictions. See the pattern? A sharp drop in demand. Either individuals and companies had less money and could not spend what they had. Which brings us to the news. Are we in a recession today? Well, we are not yet in a recession, but the possibility of one has increased in the context of Russia's conflict with Ukraine, rising gas costs, and the Federal Reserve's attempt to battle inflation by raising interest rates. It has caused volatility in the financial markets and significantly raised doubts about how quickly the world economy can recover. The world has started to shift, and so have the risks. The threat of persistently high inflation, which raises the probability of societal instability, is intensified by higher commodity prices. There is a higher chance of trouble in some industries, such as automotive, transportation, and chemical ones. A few months ago, the S&P 500 entered in a bear market when prices tend to go down. So, is the economy going to follow and enter in a recession? Well, no one can predict it. But we can analyze past events to have an idea of what's next. A common way to evaluate the value of a stock is to look at its price-to-earning ratio, or PE ratio, which shows how many years of profits at the current pace are needed to make back an investment in a company. Here is the graph. The inverse link between price-to-earnings ratios and the yield on bonds is a common aspect. Price-to-earnings ratios and the yield on bonds is a common aspect of the financial markets. For instance, interest rates were high in the early 1980s, ranging between 15 to 30%. The S&P 500 index's average PER, or price-to-earning ratio, at that time was about 10. But as interest rates fell to 8% and down, it increased to more than 17.6 P ratio on average. Let's get back to today, and we are seeing this same relationship. Interest rates have risen during this year, and the P ratio went from about 38 to 21.6 now. But that does not mean that the bear market is over. The average P ratio is 16. And again, we are at 21.6, which means the market could go down 25% and probably even more. Okay then, should you be worried? Or should you even care? I don't personally, because I do one thing consistently every month to prevent it. It is so simple. It is just putting aside some money, and the best place to start is by creating a budget. Budgets are your financial strategy, and they may include cuts in spending, but it does not have to. A budget is just a plan. It is neither a taskmaster nor a prison. Making a budget is primarily an exercise in determining where your money is coming from and going to. You must know the inputs and outputs, and determining which items can and cannot be adjusted. The primary objective is to understand where your money is going and what matters most to you. It includes everything you need: spending, income, investing. And if you want, I can make a video on it with pros and cons. Okay, so now that you know how to get fully prepared and save money, the question is how to make profits in a recession. Investing 101. Buy low and sell high. Whether you're looking to purchase a home or have money to invest in the stock markets, a recession is a good time to buy now and profit later. The goal is to keep your money invested until the market recovers, and it always did. Here is a graph of a recession and futures of some of them. As you can see, it always recovered. It can take a few months, maybe years, but it always did. I would choose the stock market because, well, it's still more affordable than I mentioned today. We have 3 different types of companies to invest in that perform way better than the market during a recession, no matter what happens to the economy. So, everyone in this world needs healthcare, consumer goods, and cheaper foods during a recession. In the healthcare sector, I would choose CVS. In addition to being the parent business of one of the largest pharmacy benefit management organizations, CVS is a well-known chain of drugstores. In addition, CVS has significantly expanded its presence in the health insurance market through its 2018 acquisition of Aetna, with operations in up to 70 countries. Procter & Gamble has grown to be one of the biggest consumer goods firms since it purchased the personal care brand Gillette in 2005. And finally, the biggest network of fast food in the world and one of the most recognizable brands, obviously, it's McDonald's. The business operates in more than 39,000 sites and over 100 countries. The company, a pioneer in the fast food sector, has maintained steady, moderate development via reasonable prices, prompt service, and consistently enhancing and updating its menu choices. It went through many recessions, and obviously McDonald's is still there, still standing. So, recessions happened in a cycle, and even though we cannot predict it, we can still get fully prepared and have some money aside, invest during recessions, and make a profit. Thank you for watching the video, and I will see you in the next one.